How would somebody go about understanding and deciding if the business plan is reasonable?
It's all about assumptions. They say in computers, they used to say garbage in, garbage out, right? And this is the same kind of thing here, is that when somebody projects some investment performance from any passive investment, they're going to say, we expect it's going to earn this internal rate of return, or that cash on cash return, or this equity multiple. Whatever it is, they're basically telling you the performance that they expect you to, that they want you to expect to see from the investment. The difficulty of all this is, though, is that any performance projection is simply an exercise of financial engineering. And behind the scenes, there's a real estate sponsor that wants to get a deal done, who's pulling on a variety of different levers until they figure out, how do we get to the return I'm going to need to promise? In other words, if I dial up the rent growth a little bit, or dial down the exit cap rate, or dial up the occupancy rate, or dial down the loan interest rate a little bit, then I can get where I need to get. So there's all kinds of manipulation that can take place behind the scenes. So what's really important is that you look at all the assumptions that are being made in the underwriting. What vacancy rate are they assuming? What rent growth are they assuming? What interest rate on the debt are they assuming? All these different things come into play because they're all going to tell you whether or not the projected return is promising. The mistake that people too often make is they say, oh, I've got 5 different investment alternatives here in front of me. I'm going to pick this one because it has the highest projected IRR. And what they might fail to realize is that that one has the highest projected IRR because that sponsor is being overly aggressive on a number of assumptions that arrived at a higher promised return than what some of the other guys were using. So it's really important to know, that garbage in, garbage out philosophy, and make sure that the underwriting projections are reasonable.
No, that makes so much sense. So you actually have to know how to do a little bit of deal analysis going into it to be able to ask some of these really important questions. And where do you recommend people turn to start learning some of those basics to make sure that they are going to be well positioned to make some of those decisions?
Yeah, there's a lot of books on there about real estate investing and general real estate investing and commercial real estate investing, specifically multifamily investing. There's a ton of books out there. You certainly got to get yourself educated. What I tried to do in the Hands-Off Investor was to condense basically all of the knowledge that you would need to be able to analyze those assumptions in one spot. So we've actually got a couple chapters of the book that are dedicated solely to real estate investment analysis. And these are so hyper-focused that a lot of real estate sponsors would probably learn something by reading those chapters. And the goal here wasn't to teach you how to be a real estate investor. It's more about teaching you, kind of like, if you think of it this way, you don't teach the building inspector doesn't have to be a contractor, but the building inspector has to know enough about construction techniques to know if the contractor did their job. And this is the same kind of thing where I'm trying to teach you how to be the building inspector. And you don't have to know how to go invest in real estate, but you have to know all these different real estate underwriting metrics and key performance indicators and all kinds of different things. And I put that all in one spot in the book.
No, that makes so much sense. Well, so we've begun to do the analysis specifically on the sponsor. We feel comfortable with them. Now we've done our analysis on the deal. We've got ourselves educated. We feel confident and comfortable in it. What comes next?
What comes next is an investment commitment. And this is where the rubber really meets the road. It's funny how it's all a theory and concepts until it's time to start to sign a check. Once you go to sign a check, it's like this just got real, right? Mm-hmm. So now it's time to sign the subscription agreement, which means, first you want to review all the offering documents, the private placement memorandums, operating agreements, subscription agreements. Make sure that the language in there, that there's no, hidden gotchas, so to speak. There can be onerous terms contained in those documents, like overly high fees, unfair profit splits, onerous capital call requirements where you could be required to put more money in after you've made your investment, transfer restrictions and all those different things where you can get tripped up by the language in the operating agreement. And so I try to go through, what to look for and what to avoid. And one of the big things I think that trips up a lot of people is the capital call provisions and getting stuck. I've actually heard of investors being required to put up money after they got into a deal. And sometimes that can be a real problem for some people.
And what are some of those other things people want to keep an eye out for when they're at this stage of investing?
One of them is the fee structure that the sponsors are charging. And, there's fees that are market and there's fees that are out of market, and you see both. And, one of them that's kind of an interesting one I always get a good laugh out of is the asset management fee. And the asset management fee is always 1%. And I don't care who you talk to, every sponsor, their asset management fee is 1%. But nobody ever says 1% of what. And it really makes a big difference. And so this is where the language, the technical language, can be a real gotcha. So, while one sponsor might be doing 1% of collected income, another might be doing 1% of the total purchase price of the property or 1% of the amount of equity that was raised. And that 1% is a wildly different number. One could be about 10 times higher than the other. So you have to be careful and make sure that you understand exactly how the fees are based and what the calculations come out to be. And then also to see if those fees are actually included in the financial projections to know if they were an afterthought or if it was already built into the financial modeling so that you know whether or not they'll affect the promised return.
Okay, well, that makes so much sense. So, we've come full cycle. We've gotten our sponsor, we've gotten the deal, we've invested our money, and at this point, we have written that check and we're invested in this deal. Now we're truly a hands-off investor. Well, what else would you want to share with folks that they need to know after the point of making that investment and what they can do to make sure that things go well?
Yeah, that's the real point where you've actually become more passive is once you've made the investment. We call this the hands-off investor. It's called passive investing, but until you've made your investment, it's anything but passive because you're very active when you're looking for sponsors to invest with. You're analyzing sponsors and trying to determine who's worthy, of your investment. That part of it is very active, and if you take a passive approach to it, that's where you can make a lot of mistakes. Once you've gotten past that point and you've made your investment, now you do get to shift to passive mode. Let the sponsor do all the work while you basically just, the old adage is you collect the checks, or at least you hope you're collecting checks. So, but in the meantime, you still have to keep an eye open to what's going on. So you should be receiving reports on a routine basis from the sponsor. You want to make sure you're reviewing those reports and making sure that they're telling you what's going on, that they're keeping the lines of communication open. Are they delivering, not just the good news, but the bad news? Are they being realistic in their assessment of where we are today? If there's challenges that lie ahead, are they telling you about that? You want to be looking at the income statements and balance sheets to see if the distributions that you're getting are connected to the actual property's income. And there's a few tricks I go over in the book on how to do that and some things to look for. There's ways that sponsors can hide the true performance of the asset and catch you off guard. So you got to keep your eyes open, but from this point, you should just be in pretty much passive mode, just paying attention every quarter to your reports.
That makes sense. And what's one of those little nuggets that people should be looking for within those reports?
The big one that I think is probably the most common is to look to see if the sponsor is hiding bad debt on the balance sheet. And so what happens is, these investments use a method of accounting called accrual accounting, which means that when rent is due, it's booked as income. And when it's collected, it's booked against accounts receivable. But what can happen is they can bill the income every month, but if no one pays it, you still have the income, but you never got the cash. It's sitting in accounts receivable. And there's the easiest trick is you look at the balance sheet and you look at the accounts receivable, and what you're looking at is to see if it consistently grows and grows and grows quarter after quarter after quarter. And if it is, there's a good chance that the sponsor might be burying bad debt on the balance sheet and not writing any of it off as a bad debt loss. So if all you're doing is looking at the amount of income, you would think the property is performing great, but really it might not be.
Today's episode is sponsored by Von Finch Capital. If you're interested in investing alongside me in the same type of real estate opportunities that I personally invest in, then head over to Von Finch Capital and join their private investor network. You can do so at vonfinch.com/invest. Join me on that next deal, and I look forward to seeing you on the inside. Thank you for listening to the Investor Mindset Podcast. If you like what you heard, make sure to rate, review, subscribe, and share it with a friend. Head over to theinvestormindset.com to join the Insider Club, where we share tools and strategies from the top investors and entrepreneurs on how to take it to the next level.